5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Credit fears. Stocks dip as two regional banks say they were victims of suspected fraud on loans in their portfolios, and that's casting doubt over the health of the industry. Talks in sight. President Trump announces another meeting with his Russian counterpart. President Zelenskiy set to visit the White House later today. And a win for autos. U.S. carmaker is set to get a 5-year extension to arrange new tariff rates on imported car parts. So we did have a down day yesterday, as you all know by now, but still we weren't down a full percentage point on either the S&P 500, the Nasdaq 100 or the Russell 2000. That may change today, though, with futures pointed notably lower. That said, the debate rages on. Is this just into weekend selling? Are people overreacting? Ed Yardeni says, yes, there might be a few cockroaches, but there's certainly no infestation. He's just one of the voices today. Let's take a look at the bond universe, though, because we're pricing in 2 Fed cuts. He says, Ed Yardeni that is, that will keep this equity market supported. And you have yields much, much lower. So we're below 340 on the 2-year yield. Remember, 345 was the level to watch. Well, we're 6 basis points below that now. And while we were flirting with 4% and it barely dipped below it during the week, we are now very firmly below 4%. 395.52 and below 460 on the 30-year yield as well. The VIX continues to rise. We went from 27 to above that today. Gold continues to hit records. We're above 4,300 an ounce today. And Bitcoin, well, Bitcoin's just lost. All right, let's get some individual movers now and the details across to London. And Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with a check on those regional names that really grasped our attention into the close yesterday. Both Zions and Western Alliance are in the red. Now, both of these closed at the lows yesterday. Zions was down 13%. Western Alliance was down 10%. So adding to those losses, and this is all around worries about collateral. Zions had alleged some collateral fraud when it came to some loans that had extended into the distressed commercial real estate space. So banks, again, a big focus in pre-market. They were also a huge focus in the European session. Just take a look at these European banks. They got absolutely clobbered in trading. Deutsche Bank down 6.5%. Barclays down 5.5%. BNP Paribas down just shy of 4%. Bonnie, it was the worst session for European banks as a sector since August of earlier of this year. So real, I guess, contagion risk is being felt around the globe, especially in European banks in the session today. Lastly, I want to touch on pharma. Trump hinted in the Oval Office yesterday he wants Ozempic and other weight loss drugs to be priced at $150 a month. That is starkly lower than the $1,000 a month price that they normally go for. So we're seeing the likes of Eli Lilly and Novo Nordisk down over 4%. Obviously, if Trump is pressuring them to lower prices, their margins will be hit on the back of that. Bonnie?
Absolutely. Valerie, thank you so much. That's Valerie Teitel there in London. And later in the hour, we're going to dig into those U.S. banking jitters with Seema Shah of Principal Asset Management. So, to that story then, broader market story even as credit fears spook investors widely. That's after, as Val said, Zions and Western Alliance revealed losses from alleged loan fraud. Joining us now from our finance team is Stephen Ahrens. You know, Ben Emmons of Further Capital today, Stephen, saying that there are shades of SVB here. But we're talking about a relatively small amount, no?
Yes, you're right. The amounts for these two banks, the losses are actually quite small, in the tens of millions and something. But they come on the back end of losses we've seen on the First Brands collapse in the U.S. And the Tricolor one, which has raised concern generally about what's going on in the credit risk among banks. That's spilling over now to Europe. So these things are piling up and increasing anxiety for banks, and that's why the hit's so big right now.
The other point about it is that we're talking about private credit here. We're not really talking about a broader, more public credit type of situation. Is there a fear that it will bleed into the other parts of the market, or what is the fear exactly?
That's happening too. You're absolutely right. So, I mean, by definition, private markets and private credit is private. So there's little information. The banks know little about it. There's concern across banking that they've invested and lent to private credit borrowers, and they're exposed where they don't know about other people's exposure. These add up, and the opacity is now something that's growing, that's causing growing concern. They are worried about it. It used to be it's a booming asset class. Banks have built up massive exposure, and they're concerned now it's coming home to roost.
So what is the solution here? If it's private credit for a reason, I guess it's a little opaque, but surely the people actually lending the money are supposed to do their due diligence. Is there a suggestion that there are plenty of bad actors out there, or that there just isn't enough information to be had?
Well, as is typically the case, if it's a booming asset class and someone else lends to, some private credit borrower, and then the next bank says, oh, whatever has lent money to them, so I'm just going to do it too, and they just tick the box of the, due diligence. So when such a big business is happening, at some point the banks tend to cut corners, and this is now what's again causing concern, that they've not done the due diligence sufficiently enough, and have exposure in their books that they're not even aware of, that risks have built up that they're not aware of, and that could come and explode into their faces.
All right, and I do want to point out that we get results from Truist and State Street after the bell today, so perhaps we'll get more comments out of those banks. Stephen, thank you so much. That is Bloomberg's Stephen Ahrens. Meanwhile, President Trump and Russian President Vladimir Putin held a 2-hour call yesterday and agreed to meet again within 2 weeks in Budapest in an effort to end the war in Ukraine. He spoke to reporters about the conversation.
And I thought it was a very good phone call. I thought very productive. But I'll be meeting with President Putin, and we'll make a determination. Tomorrow I'm meeting with President Zelenskiy, and I'll be telling him about the call.
Joining us now is Bloomberg's Roz Matheson. So the timing of this announcement, Roz, does it undercut to a certain extent the meeting today with Zelensky?
Well, it's possibly a bit concerning for Ukraine that Donald Trump did get on the phone with Vladimir Putin yesterday ahead of this conversation, because he's blown a bit hot and cold on Vladimir Putin, and he was a bit cold lately. He was obviously frustrated that Vladimir Putin is dragging his feet on ending the war in Ukraine, and was like looking to put up the pressure on Vladimir Putin economically, sending potentially Tomahawk missiles to Ukraine. And the question is, what did Vladimir Putin say to him yesterday? Did he start to promise him, yes, I am serious about ending this war. Let's meet in person in a couple of weeks. We'll talk about it there. Again, he's just pushing the timeline back, Vladimir Putin. He goes from, meetings to calls, and then nothing really happens. And so for Ukraine, the concern is Donald Trump again engaging with Vladimir Putin in this way? Is this just Vladimir Putin looking to drag things out to Ukraine's detriment? Or perhaps, for Donald Trump to say that Ukraine has to be the one that makes concessions to end this war or to get a ceasefire. So certainly for Zelensky today in this meeting, the imperative will be to encourage Donald Trump to keep up that pressure on Russia, both through sanctions and possibly through supplying Ukraine with those missiles.
Roz, Trump has momentum after his Gaza plan was at least partially accepted. Is there the possibility that he might come up with a plan even in private for ending this war? I mean, it's obviously a very, very different war.
Well, that's right. So obviously he's coming off the back of the Gaza ceasefire, where the US did really pressure both Israel and Hamas to get there. And the question is, in his eagerness perhaps to get yet another notch on his belt when it comes to these ceasefires that he says he's helped arrange around the world, is he possibly at risk of rushing things with Vladimir Putin? I mean, Vladimir Putin's a very canny operator. Does he promise Donald Trump things? Does he say this is what we can do to get this done? And Donald Trump perhaps, is willing to, again, he said previously, Donald Trump, that he's willing to talk about territorial concessions that Ukraine may need to make to end this war. Does he come back into that conversation? And so, in his desire perhaps to get another ceasefire done, and this one's been arguably the most difficult of all since he became US president, is he willing to entertain some of those demands that Vladimir Putin has?
Roz, thank you so much. That is Bloomberg's Roz Matheson there. In Washington, Bloomberg reported the U.S. Commerce Department is prepared to ease tariffs on the U.S. auto industry, an announcement that could come as soon as today. Joining us now is Bloomberg's Eric Pfanner. So this announcement is likely to relate more particularly to auto parts. Eric, what are we expecting to hear?
Yeah, that's right. Good morning. So the announcement we're expecting to hear relates to an offset that car makers who build cars in the U.S. were allowed to use for the parts that they import. Now, currently, under Trump's plans, they're facing, under his tariffs, they're facing tariffs on both the parts and any cars they bring into the U.S. But under this extension of an offset that's been put in place that would go on for another 5 years instead of being phased out, and allow them to offset some of the tariffs that they pay on those parts if they bring them into the U.S. and then build the cars in the U.S. So it's a measure of relief. It's a little bit incremental, but it does help and provide a bit of certainty for the car makers that are planning their U.S. operations.
You know, Paul Donovan of UBS says that this extension on car part tariffs shouldn't be read as a wider signal for tariffs more broadly because there was intensive lobbying. But could other industries use the same playbook, Eric?
Well, I mean, we're certainly seeing a lot of lobbying, across the industrial sectors, across the entire corporate sector, really. We've seen a lot of action with pharma of late, of course, and so I'm sure it won't be the last sector that tries to get deals. We'll continue to see this has been a movable feast with tariffs, of course, and we're probably not done with cars necessarily yet either, and pharma is still a work in progress, of course, with both the pricing and the tariffs issues. So yeah, I think we'll see continued lobbying from a lot of corners there.
If you have an extension for that long on tariffs on auto part imports, do you try to readjust your supply chain, or do you wait and hope for the best?
Yeah, I think what this does is it provides a little certainty at least. So obviously if you're planning to build a plant, you've got to know that it's going to be viable, economically viable for at least a few years. And it's a lot easier, though, still to build one plant rather than try to import an entire supply chain, which then becomes a whole lot more complicated. So I think this is a bit of a realization of that even if you're trying to get people to build plants in the U.S., you can't get them to import the entire supply chain. So, in that sense, I think it does provide maybe a bit more incentive actually to go ahead with some of these things if you have some certainty that, okay, for at least the next 5 years, we're going to get a measure of relief that allows us to plan our investments.
Eric, thank you so much. Bloomberg's Eric Fanner there. Now to other top stories trending on the terminal this morning. First up, Man Group's assets have hit a record high in the 3 months through September, reaching $214 billion. The world's largest publicly traded hedge fund saw clients pour more money into long-only products, and performance improved. Volvo warns that a demand slowdown will extend into next year as uncertainties over tariffs linger. The car maker has posted weaker orders and lower earnings while projecting declining North American truck registrations for 2026. And BBVA chairman Carlos Torres says he won't be resigning over the failure to buy rival Banco Sabadell. The comments come after the $19 billion offer for smaller rival Sabadell was rejected by 3/4 of the shareholders late Thursday. Coming up, the latest deal driven by the AI race. Meta and Blue Owl are close to finalizing the largest private capital deal on record. We'll have details next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. A record for Meta's latest AI data center. It's close to finalizing a $30 billion package to finance the site in Louisiana. The deal with Blue Owl Capital will be the largest private capital deal on record. Joining us now is Bloomberg Tech Europe anchor Tom McKenzie. So Tom, what is the advantage exactly for Meta in going the private capital route here?
Well, to preserve its credit rating is certainly one part of the rationale. And this is a reminder, I think, the story and the numbers that you just read out there, Vonnie, as to the reach that these hyperscalers are going for when it comes to creative financing to build out the massive data center and infrastructure build around AI. And clearly Meta is playing a significant role there. So as you say, $30 billion US, that's made up of about $27 billion of debt being raised by Morgan Stanley, but also about $2.5 billion in equity. It's going to be housed in a special purpose vehicle, and the debt and the equity will be backed by the physical infrastructure itself. Meta will have about 20% ownership. It will operate the data center itself, but only have 20% in terms of the stake. PIMCO is also playing a role as well, at a time, of course, where we see hyperscalers and the big tech companies actually tapping the US bond markets. That amount they've raised on the US bond markets this year is up about 70% from last year. This is another tool and another framework then that hyperscalers like Meta can use to fund this massive build out. This is just one, of course, of Meta's data centers that they have planned. This one of their largest in Louisiana.
Yeah, and you have to imagine it's going to provide a roadmap for other hyperscalers, as you mentioned. Tom, can we move to Oracle now? Because we did get some more details after the bell yesterday, helping to ease fears really around AI-related margins in particular that had started to percolate, and those fears were adding, of course, to this bubble discussion. Can you give us the details on what Oracle told us?
Yeah, absolutely, Vonnie. And look, you've covered this and you're aware of this as well. And it's something we've been noting over the last few weeks and months, which is just the sheer number of deals that have been coming through. And Oracle has been a key player in that, signing deals with the likes of Meta as well, XAI, OpenAI, to build out again and run data centers that underpin some of these hyperscalers and large language models. And what they have come under pressure on is, fine, you've got all of these deals, you've signed all these contracts, but how much is it going to cost you, and is it going to squeeze on the margin? And there were some estimates of 14 or 15% margins, which is clearly not going to be enough for investors. They turned around yesterday and said, look, we have a better projection now in terms of what the margin story could be. And they gave an example of a $60 billion revenue data center over 6 years, providing a margin of 35%. Much more comforting then for investors exposed to Oracle. 35% was the margin they're projecting. They also, by the way, raised their revenue targets for 2030 up to $225 billion US dollars per year, and they raised their profit margin as well, or profit target, per share profit target. So all of those things coming together to give investors a little bit more comfort. And it was really the margin story, as you say, that was central to that, given that projection and easing some of the concerns about the squeeze on profit that could be coming through as Oracle plays an increasingly large role in that data center story.
And the stock did spike on that news, although it did temper the gains a little later on. Bloomberg Tech Europe anchor Tom McKenzie, thank you so much. Coming up, we'll bring you our conversation with Hong Kong Financial Secretary Paul Chan on HSBC's plan to privatise Hang Seng Bank. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. HSBC has vowed to invest heavily in Hong Kong and the region and has forsworn layoffs as part of its deal to take Hang Seng Bank private. This is all according to Hong Kong's financial secretary. Take a listen to more from my conversation with the secretary, Paul Chan.
From our standpoint, this is business decision, and according to HSBC, this is an rationalization of their organization structure. They will continue to invest in Hong Kong and serve the public under separate entity, separate plan. Substantial investments will be made. So we take it as an additional possibility to better serve their clients. Yeah.
When you say additional investments, can you be a little more specific? Are you talking, a dollar amount? Other promises, like, for example, not firing some workers, not laying off workers?
Yeah. According to what they have told us, there will be no layoff, and the investment will be in the billions of dollars, not just in our market, but in our region. But Hong Kong, as you know, we are super connector, so connecting the mainland with the rest of the world. And Hong Kong is the best gateway for international businesses venturing into the mainland market.
So HSBC has promised to invest billions of dollars in Hong Kong and the region. How will it do that?
Well, it's over the next few years in terms of customer service, in terms of their technology. And as you know, say, for example, in Hong Kong nowadays, private wealth, asset management is promising. So not just HSBC, but there are some other international financial institutions adding headcounts in this respect to capture the opportunities.
When it goes ahead, what do you know about HSBC's plan with Hang Seng? Will it, for example, be on sale after it's privatized?
Well, this is a matter for the bank, but this has not been made to us as a plan.
Part of my conversation there with Hong Kong Financial Secretary Paul Chan. Time now for your front page news. And we'll get to that in a second because I want to have a quick look at this market. The VIX has just dipped below 27, but take a look at these futures. Now, they're off their worst session levels. Still, though, we're looking at a decline of perhaps a percentage point for the S&P at the open. Now, bear in mind, we'll still be up on the week, potentially, because we had an up day, a down day, an up day, a down day. So we'll just see where we end up today. Let's not get too ahead of ourselves here. We are going into the weekend, too, so there could be some risk-off sentiment, just taking off some some of those more risky bets. Certainly there are commentators out there like Ed Yardeni that see maybe cockroaches, but certainly not an infestation. So this regional bank sell-off that we saw yesterday after two of them decided they were victims of fraud elsewhere, well, it may or may not be something that's contagious. Let's though take a look at yields, because we saw a major sell-off in yields yesterday. Bonds very bid, to the point where you have the 2-year at 339, the 10-year at 396, and the 30-year at 357. Now, that's the lowest in years. The 2-year is lower than at any time, even during the SVB episode between now and 2022. So we're literally at 3-year lows for the 2-year yield. And let's take a look at gold, because we continue to hit records. We're well above 50 records now for gold. We're trading at more than $4,300 an ounce. Oil selling off as well. And the dollar index is weaker today. We have a stronger euro. It's back above 117. And the yen is trading below 150. Coming up, Seema Shah, Principal Asset Management Chief Global Strategist, is next. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Credit fears. Stocks dip as two regional banks say they were victims of suspected fraud on loans in their portfolios, and that's casting doubts over the health of the industry. Talks in sight. President Trump announces another meeting with his Russian counterpart Vladimir Putin. President Zelenskiy of Ukraine set to visit the White House later today. And a win for autos. U.S. car makers set to get a 5-year extension to arrange new tariff rates on imported car parts. So if you're looking at futures today, you'll see a significant drop, particularly as we've had an up day, a down day, an up day and a down day this week. However, we must point to the fact that the KBW Bank Index was down 3.6% yesterday, and that's stoking fears of contagion after these two regional banks said that there was stuff on their books that they didn't fully realize and that there might have been fraud attached to those loans, and it was impacting their results. Now, will there be more of those cases out there? That's the big question. If not, back into earnings next week. We have a couple of tech earnings, for example, IBM and Intel and so on. And also the idea that we are definitely in for 2 Fed rate cuts according to the market this year. So we may be back to our 50-day moving average on the S&P, but the market still substantially supported. Let's look at yields. Ben Emmons calling the whole matter shades of SVB, and it certainly did send yields lots lower. That, of course, and Fed speak yesterday, plenty of it. The 2-year yield is back up a little bit, but it was down to its lowest in 3 years, even lower than it was during the whole SVB matter. It's now at 339. And we have the 30-year yield 457, that 10-year yield well below 4% now. Let's get across to London for some stocks to watch. Here's Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with a check on those regional banking names that you were just mentioning, because again, they are in the red in pre-market. Zion's falling over 1%. Western Alliance down nearly 3%. Now, Bonnie, this is an important one because we also have 4 other regional banks reporting earnings today before the bell. Watch out for Fifth Third, because they did previously disclose exposure to Tricolor. So this negativity around regional banks could gather some steam after those earnings results before the bell. But it had quite an impact on the European session. European banks got absolutely torched at the open and continue to do so. Deutsche Bank down 6%, Barclays down 5%, BNP down just shy of 4%. But the banking sector as a whole in Europe is having its worst session since August earlier this year. Now, this is stoking fears of contagion, as you mentioned, but we're also seeing those fears reverberate across the globe in Asian and European banks. Lastly, we do want to end on a check on pharma. We had Trump in the Oval Office yesterday talking about weight loss drugs costing $150 a month. They currently retail around $1,000 a month. So this pressure again on these drug makers to reduce prices is especially hitting those involved in the weight loss drug space. Eli Lilly down nearly 5%. Novo Nordisk down 4%. Bonnie?
Valerie, thank you so much. Valerie Teitel there in London. Well, let's get more on these credit fears driven by those disclosures by Zion's and Western Alliance. Stephen Aarons of our finance team joins me now. So clearly, these stocks took a hit. The regional bank index, as I said, was down more than 3.5%, Stephen. But why should the larger banks be affected? Is there a real fear that perhaps managers don't know exactly what's on their books?
Yes, I think that's exactly what's happening. It's a bit fear, maybe concern at least, that there is something happening, that there's something in their books that they're not fully aware of. This comes on the back end of other cases, big insolvencies in the U.S. of Tricolor and First Brands that have stoked fears that banks are exposed to credit risk that they're not fully in control of. And on the back end of a big boom on the asset class, people are just taking a very big step back and thinking, what exactly is in the books? We want to have more information, and until we know more, we're just going to be very careful here.
Well, we're going to get announcements and earnings calls from 3 more regional banks today. I guess that could either add to or calm jitters, because this could be a self-fulfilling thing if we don't get somebody coming out and saying, look, it's not as bad as all that, right?
You're absolutely right. I mean, every single investor who's invested in bank stocks right now will be listening extremely carefully to any comments on any bank earnings call, to exposure to these cases and perhaps new ones. So I think credit risk is going to be the major theme during the earnings season that we're facing right now. I'm looking, of course, at the European banks, which are getting ready to report, and that's exactly what I'm going to be, keeping an eagle's eye on. Credit risk is the theme right now.
Exactly, and here in the US, we get State Street and Truist before the opening bell. Stephen, thank you so much. That's Bloomberg's Stephen Ahrens. Joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. So I've seen both sides of the coin in commentary, Seema, those that say, yes, this is some of our prophecies coming true, and those that say, look, no, there's no infestation here. This is a few cockroaches, that specifically was Ed Yardeni. I mean, how are we supposed to know, right?
Hi, Vonnie. I think that's a key thing. And as Stephen was saying, there's a lot of uncertainty. So at the moment, the market is really in that discovery phase, trying to understand exactly what the exposures are, the drivers. And essentially, is this something which is idiosyncratic or is it systemic? It's coming, unfortunately, at a time when I think the market was already a little bit vulnerable, given it's been sitting at record highs. You've already had, valuations very, very expensive. And then a couple of bad news themes just coming through from a trade side as well. So there's already jitters, and this hasn't helped. The early indications from our side are that this is something which shouldn't be considered as systemic. Typically, fraud shouldn't indicate that. It may, of course, be a signal of a deeper problem, maybe if it's economic difficulties. But taking a step back and looking at the broad economic picture, we still see the kind of a fairly constructive backdrop. You've seen defaults and high yields leveraged loans actually trending lower, not higher. So I think those things give us some reassurance, because as I said, this is really discovery phase at this moment.
Yeah, and I know you're constructive going into 2026, but you also had thought that the market was vulnerable, particularly around the AI narrative and also even the growth picture. So I'm curious, what would it take for risk appetite to disappear for a more extended period than just a couple of days?
Yeah, I think that it's something which is either going to really impact the growth outlook, so completely changing the path of where the US and the global economy is heading, and maybe that would be something on the AI side. Or certainly, a continued rationing up of the trade tensions. That's the kind of thing that we would be particularly worried about. And then from a regional banking side, is this something which is systemic, which is giving us an indication of deeper fears? At this point, as I said, this is not what we're expecting, but certainly it does make sense that investors from this level are going to be extremely cautious and watching out for that credit risk.
We're watching State Street and Truist today like we've never watched regional banks before. I'm curious if we do get more comments, or even just not from these banks, but from other banks, that there are other problems in the system. Is it something that could be contained to just the banks, and we could still see AI and tech and so on fly?
Well, I think typically what we'd see is that investors are going to be rushing for whatever they deem to be the safe haven. Now, typically on the defensive side, that would be something like utilities and healthcare. But we have seen in recent times that a number of investors do look at that big tech side with their big balance sheets and cash flow as something of an island of safety within that kind of storm. So we could see that. But given the valuations there, it may not be the favored place to be focusing on. At this point, even at this point of discovery, for investors, again, diversification has been really key through this year, and I think it continues to be. Focusing across sectors and across asset classes. Fixed income, as you can see, given the way that Treasuries have been behaving, that continues to be a place where you can focus on if you have got concerns about the broader economy. So there are areas that make sense for investors to have some exposure to, even as they try and maximize on the areas that they do feel there is some continued strength.
Yeah, Seema, you mentioned Treasuries. How low can the 2-year and the 10-year go?
Well, it is interesting because I know there's that comparison with what was happening with SVB. And I think the biggest difference, though, is that during the SVB crisis, the Fed was actually hiking rates, whereas at the moment, we've just restarted this Fed cutting cycle. And that's one of the reasons that you are seeing these downward pressures, or at least I should see Treasuries actually moving lower than where they were during the SVB crisis. And that is going to be continued help. In terms of how low they can go, well, of course, it depends on the size of the problem. If this problem does fade out and it does seem to be idiosyncratic, then we would expect the 10-year, at least, for example, to be stabilizing at around the 4.1% level, knowing that growth is going to be fairly good, and so that the Fed shouldn't have to go into a very deep cutting cycle.
Seema, on AI, once these announcements of partnerships and deals and so on, once they peter out, because they will have to at some point, what will the next catalyst be to send those prices higher?
Well, I think we just, we want to continue to see those earnings, positive surprises. I think news of productivity gains, that's going to be really key. And I think that's something that investors increasingly are going to be looking out for. Which companies are really benefiting? Are we seeing further strides in terms of growth, which can support that continuation of the AI theme? It's still really early days, and certainly there could be some setbacks along the way. But that narrative, that theme of AI productivity gains driving the global economy is, I think, what could keep it going, even in those moments where things become a little bit more challenging.
Seema, I want to mention something that I read earlier today. Ian Lingen of BMO wrote a love letter, basically, to the data, saying, "Dear data, we miss you." And he ended with, "Please come back to us soon." I'm curious, what's the chance that when we do start getting government data again, assuming we do this year, that there will be some shocks in there, that we'll be surprised by what we see?
Well, I mean, before I attend to that, because actually this is almost key, is that because there is a lack of data, there's a lack of news flow, it has almost created this vacuum, which I think does enable fears to flourish a little bit more. So this is, I think, playing into this general theme of jittery markets too. But certainly, once we get the data back, we'll have to be fairly careful about it, because some of it will have been compromised in terms of the process of collecting data during the government shutdown. So we'll be treating it with a pinch of salt. Our view, and just taking a step back, looking at the broader picture, some of the news flow that we've been getting from earnings, particularly with regards to the consumer, we still think this is a healthy economy. The key thing that we need to be looking out for is, are companies passing on price increases increasingly to consumers? And of course, what is happening with the job market? If layoffs are staying quite low, then I think we should all be reassured. But of course, if you do start to see layoffs trending higher, then there's a bigger problem at bay.
Seema, thank you so much as always. Seema Shah of Principal Asset Management there. Now to other top stories trending on the terminal this morning. First up, Man Group's assets have hit a record high in the 3 months through September, reaching $214 billion. The world's largest publicly traded hedge fund saw clients pour more money into long-only products, and performance improved. Volvo warning that a demand slowdown will extend into next year as uncertainties over tariffs linger. The car maker has posted weaker orders and lower earnings, while projecting declining North American truck registrations for 2026. And BBVA Chairman Carlos Torres said he won't be resigning over his failure to buy rival Banco Sabadell. The comments come after the $19 billion offer for smaller rival Sabadell was rejected by 3/4 of the shareholders late Thursday. Coming up, President Trump hosts Ukraine's Volodymyr Zelenskiy at the White House today. More on efforts to end the Russia-Ukraine war next. This is Bloomberg.
And I thought it was a very good phone call. I thought very productive. But I'll be meeting with President Putin, and we'll make a determination. Tomorrow I'm meeting with President Zelenskiy, and I'll be telling him about the call.
President Trump announcing another meeting with Russian President Vladimir Putin just ahead of President Zelenskyy's visit to the White House today. Joining us now from Washington is Bloomberg's John Harney. What about the timing of this announcement, John? Is it respectful, I suppose, to announce that you're going to meet with the Russian president when, the Ukrainian president is going to be in the White House today, or does it undercut that meeting?
to the second question, yes, it certainly seems to. Here again, we see this war, the course of this war, the dynamic of this war shift dramatically in just a day. Now, that's not the war on the battlefield, which remains largely a standoff. This apparently, during this conversation yesterday, this 2-hour conversation with Vladimir Putin, Donald Trump was convinced that another summit with Mr. Putin, this time in Budapest, was a good idea, even though their last one in Alaska not only yielded no progress, but afterward, attacks by Russia on Ukrainian targets, largely including civilian targets, intensified, and you had Russian incursions of drones into Polish airspace, and warplanes in Estonia, which, of course, upset our allies, NATO allies, to the east, in the eastern region of Europe. So this perhaps will give Mr. Putin time to drag out this conflict. At the same time, Mr. Trump clearly does want to resolve this war. He promised this during the 2024 campaign. And yes, he is even more motivated after his success in Gaza just this week.
Yeah, there is some momentum, but you have to wonder, you know, every time he meets Putin, things go a little awry. And then he gets frustrated with Putin, but he's obviously going to meet with him again. I do want to ask you about the tariff relief, though, because we got the shout that we'll probably get an announcement today that the auto industry will get that relief. Can you give us the details?
Yes, the big automaker, well, two of the big American automakers, particularly Ford and General Motors, are getting a 5-year extension on tariff relief. They would still have to pay some tariffs, but not as much as they would otherwise on parts that are imported from abroad. Now, here, this shows a couple of things. One, world trade is very complex. You know, this tariff regime was installed by President Trump to bolster, to promote American manufacturing. However, a lot of American manufacturers use at least some foreign parts.
Yes.
And it also shows that trade policy is is unfolding, at least somewhat, in the offices of lobbyists.
Yes.
The automakers mounted a major lobbying campaign on K Street, as we call it here, even though a lot of them are not actually on K Street, to get this extension, which my colleagues have reported may be announced as early as today by the Commerce Department.
Seems other industries are not having just as much luck just yet. John, thank you so much. That is Bloomberg's John Harney. And to another industry now, and that is the pharma industry. Novo Nordisk and Eli Lilly shares tumbling after President Trump said the price of Ozempic could go down to just $150 a month. Joining us for more is Bloomberg Intelligence Director of Research and Senior Pharma Analyst, Sam Fazeli. So, Sam, obviously, President Trump is saying this. The deals are not, just yet in place. Is it possible that the pharma industry will have some success in pushing back on these prices?
Well, Vonnie, I think the pharma industry has already had some success in the deals that they've done, Pfizer's deal and AstraZeneca's arrangement, let's call it, with the administration in terms of how they're going to manage the pricing and availability of drugs, more affordable prices for certain segments. What is, as usual, the case here is that there's so little detail, except for those numbers that you mentioned, and the drugs specifically, the weight loss drugs or the obesity drugs, they are known. There's so little detail apart from the $150. Now, let's just remember this. We have no idea what channel the president is talking about or the administration is talking about. We don't know what they've been talking about to Lilly and Novo Nordisk. Is it just for the Medicaid channel? Remember that the net price of these drugs is around $540 a month at the moment. So, and there are slightly cheaper versions in the vials, etc. So let's just wait for the details. I think the markets decided to shoot first and then get the facts right here. It's very possible that this ends up being a sliver of the population, particularly the out-of-pocket patients as opposed to insurance patients, etc. So it might even lead to higher volumes.
Yeah, there you go. Well, that's what I was just going to ask you. I mean, if we do get a deal of some sorts that makes these drugs cheaper, but you've just sort of put a pin in that for the moment, are these companies still correctly priced, or will we see new price discovery?
To be honest with you, as usual with pharma companies, I think the best way to look at it is that as time goes by, more competitors come in, the prices tend to fall. And it makes sense also for the industry as they get their manufacturing and margins set. It becomes pretty much everything else they sell becomes leverage on their manufacturing facilities, etc. Prices do tend to fall. Now, what you don't see, of course, is in the list prices, because they go up every year, 2%, 4%, 5%, 6%. But what you end up getting is a bigger yawning gap between list prices and the net prices that the insurers pay. And therefore, what actually happens is that the net price continues to fall, or at least stay stable. And that's what we see all the time. And I don't think that's going to be any surprise in the obesity market at all for those drugs to follow the same pattern.
Yeah, I mean, you have to wonder if R&D will eventually be affected if this continues. Lilly up 6% year to date, so we'll see how it fares in today's session. Thank you to Sam Fazeli of Bloomberg Intelligence. Coming up, more earnings and a Trump-Zelenskiy meeting in your day ahead. We'll get you prepped. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. So look out for earnings before the bell from so many regional banks, including Fifth Third, Regions Financial, Comerica, Truist, Huntington. Those calls will be scoured for comments. Then President Trump will greet President Zelenskiy at the White House at 11 a.m. Eastern before a bilateral. And today we're going to hear from St. Louis Fed President Alberto Musalem. That's at 12 p.m. Eastern. Let's take a look at some movers before the bell now. So we obviously have those regional banks sparking credit fears, extending their decline today. Zion's down by 1%, is also bleeding into the bigger banks. Baird, though, has just raised its rating for Zion's to outperform after the steep sell-off. So that will give you a clue. The market jitters also dragging down big banks, as I say, with Bank of America down 1.6%, even after great earnings from all of the mega banks earlier on. Oracle down another 3.6% after a volatile 12 hours following earnings. It reassured investors on margins and even profitability, but shares fell as the firm discussed its 5-year financial outlook. And it is Friday. We are a little nervous going into today, but we have futures down by more than 1%. The Bloomberg Dollar Index looks to be unchanged, but we have the euro back above 117, the yen back below 150. It's the yield space that we'll be watching for most of the day. The 10-year yield at 3.95. The 2-year yield dropped precipitously at a 3-year low before it came back up a couple of basis points. Well, that's it for Bloomberg Brief. Surveillance continues the conversation. This is Bloomberg.